Welcome back, everybody. My name is Chris from projectoption.com, and in this video we're going to talk about the bear put spread strategy. So if you've been following along, you'll know that this is the fourth installment of the ultimate guide to trading vertical spreads, so let's get right to it. Now, as the name suggests, the bear put spread is a bearish options strategy constructed with put options. Now, here's how you set up the trade. You're going to start by buying a put option, and then you're going to sell another put option at a lower strike price in the same expiration cycle and with the same quantity. Now, with this being a bearish strategy, the strategy profits when the stock price decreases, and ideally you want the stock price to reach the short put's strike price by expiration. Now, when would you buy a put spread? Well, traders buy put spreads when they believe a stock's price will fall, but not necessarily to a price lower than the strike price of the put that is sold. So we'll talk more about this in a minute, but the basic idea is that when you buy a put spread, your maximum profit occurs at the strike price of the put that is sold, and it doesn't matter if the stock price falls another 10, 20, 30% below that short strike, because the put spread will be worth the same amount at expiration. Alright, so as always, let's go right into a real example to demonstrate how this strategy works. So first and foremost, for this particular position, the stock price at the time of entry is $780.22. Now, to set up this bear put spread, we're going to buy the 800 put for $44.88, and we're going to sell the 750 put for $22.63. Now, both of these options are in the expiration cycle that is 59 days away. Now, when you buy a put spread, you obviously are going to pay out premium because the put that you buy is more expensive than the put that you sell. So in this case, we're buying the 800 put for $44.88, but we're collecting $22.63 from selling that 750 put. So in this example, our spread entry price is $22.25. Alright, so the break even for a bear put spread is the put strike that you buy less the premium that you pay, and in this case that's going to be the $800 put strike minus $22.25 that we paid to buy the spread, which comes out to $777.75. A lot of sevens there. Now, the maximum profit potential in this case is going to be the spread width, which is $50 in this case, less the premium paid, which is $22.25, times 100, which comes out to $2,775 of profit potential. Now, the maximum loss is the premium that you pay times 100. So in this case, that's going to be $22.25 times 100, which comes out to a maximum loss of $2,225 per spread. Now, this is actually a good time to demonstrate why people buy put spreads as opposed to just buying puts. So as we can see, the 800 put costs $44.88. So if you were to just buy that put, the maximum loss potential would be $4,488. But by reducing the cost of the trade by selling a put against the long put, we only have a maximum loss potential of $2,225 in this particular case. Now, the downside is that our profit potential will be far less than just buying that put, but with all things in options trading, there are always trade-offs. So in this case, the benefit of buying a put spread is that you have a lower cost and therefore less risk, but the downside is that you have less profit potential than simply buying a put and not selling a put against it. Alright, well now let's go ahead and take a look at the expiration payoff graph for this particular bear put spread. So let's first start off by discussing the maximum profit zone for this put spread. So as mentioned earlier, the maximum profit zone is at or below the put strike that is sold. So in this case, we sold the 750 put against the long 800 put. So that means that if the stock price is at or below $750 at expiration, the maximum profit of the trade will be realized. Now, if the stock price is at or below $750 at expiration, the 750 put spread will be worth $50 since the width of the strikes is $50. Now, if the spread value goes to $50, that means the profit per spread will be $27.75 because it was initially purchased for $22.25. All right, with the maximum profit zone out of the way, let's talk about the break-even price. So as we discussed, the break-even price for this trade is the long put strike of $800 less the premium paid of $22.25. And that comes out to $777.75. So why is that the break-even price? Well, if the stock price is right at $777.75 at expiration, the 800 put will be worth $22.25 because the stock price is $22.25 below that put's strike price. Now, with the stock price above $750, the 750 put will expire worthless, and therefore the net value of the 800 750 put spread will be $22.25 at expiration. And since that's the initial purchase price, there's no profits and no losses. And lastly, let's talk about the maximum loss zone for this trade. So the maximum loss of a bear put spread occurs if the stock price is at or above the long put strike price at expiration. Now in this case, the long put strike price is $800. So if the stock price is at or above $800 at expiration, the maximum loss will be realized. Now this is because the 800 put and the 750 put will both expire worthless, and therefore the value of the 800 750 put spread will be $0. Now, since you paid $22.25 to enter the spread, but it expired worth $0, the loss per spread is $22.25. Now, of course, we have to multiply that by 100 to get the actual loss of $2,225 per put spread. So now that we've talked about the expiration payoff diagram, let's go ahead and visualize how this put spread actually performed as the stock price was changing over time. All right, so on the right side, we can see the chart that shows the changes in the stock price, and on the bottom part of this chart, we're looking at the changes in the price of this 800 750 put spread. So right off the bat, let's focus on the period between 59 and 25 days to expiration. So as we can see, right when we buy the put spread, the stock price rallies, and as we can see on the bottom part of the chart, the price of the put spread falls significantly. And that's because if you buy a put spread and the stock price increases, those puts that you purchased are going to decrease in value, and that's going to lead to a cheaper put spread since the stock price is now further away from that put spread. Now, if you buy a put spread and its price decreases, then you are going to lose money. So in this first initial period, we can see that we purchased the put spread for $22.25, but the stock price rallies from right around $780 all the way up to around $850. So a very substantial increase in the stock price, and with that, the price of the put spread decreases significantly. So in that first period, this put spread position did not work out well for the person that purchased it. Now, fortunately for this bear put spread position, in the final 25 days before expiration, the stock price goes from $850 all the way down to $720 at the lowest point. And as we can see there, the price of this put spread actually got close to $50, which means there was a point in time in which this trade was maximally profitable, or at least almost maximally profitable. Now at expiration, the stock price was at $760.16. So not quite maximally profitable, but pretty close to it. So with the stock price at $760.16 at expiration, the long 800 put is worth $39.84, and that's just because the stock price is $39.84 below the put's strike price. Now, since that 750 put is out of the money, the short 750 put expires worthless, and therefore the net value of the 800 750 put spread is $39.84 at expiration. Now that means the profit per spread is $17.59 because the spread is worth $39.84 at expiration, but was initially purchased for $22.25. Now, of course, to convert that spread profit to actual profits, we simply multiply by 100, and we get to a net profit of $1,759 in profits per spread. So hopefully by looking at this example, you can see that when you buy a put spread, you want the stock price to decrease and ideally get to a price equal to or lower than the short put strike of your trade. Now, if the stock price increases, the price of those puts that you purchase are going to decrease, and therefore the price of your spread will decrease and you'll have losses on your position. Alright, well that covers the bear put spread position, and to quickly recap, the bear put spread is a bearish vertical spread constructed with put options. Now you do so by buying a put and then selling another put at a lower strike price in the same expiration cycle and with the same quantity. Now ideally, the stock price will fall to a price equal to or less than the short put's strike price by expiration, because that is where the point of maximum profitability occurs. Now, as we mentioned earlier, if the stock price plummets to that short put strike price, it's not going to be a bad thing for your put spread, but if that occurs, you would have been better off just owning the put. Well, I hope you enjoyed this video, and in the next lesson, we're going to learn the fourth and final vertical spread, which is the bull put spread strategy. Now, after that, we're going to start getting to more specific topics such as time decay and implied volatility, choosing expirations, choosing strike prices, and finally, when to take profits and losses when trading vertical spreads. I'll see you there.